Today's topic is going to be around where we're headed into 2025. What are the outlooks, where we thought we were going, and where the current disruptions or potential disruptions are making people feel about where we're going. We've reviewed extensively few initial outlooks in the year from reputable research and outlook experts. And then with the recent events this week, we said, okay, let's see what else is happening, how's the sentiment, and let's update it accordingly. We anticipated that we normally do this in January, but we anticipated January and February to be a little bit rocky. So we decided to do it in March, and I think that was a wise decision. So with that, I'll start with the general disclaimer. This is just intended for educational purposes. For any investment decision or any decisions in general, make sure you consult with your legal financial advisors before you proceed. But we're here to learn from each other. If you have any insights throughout or any data that you came across, it'd be great to share and learn from each other. Today, we're going to cover the 2025 general economic outlook and how it relates to commercial real estate. We'll look at the possible extension of the Jobs Act, the Tax Cut and the Jobs Act, which we feel is likely. And what does that mean? Um, Preparing for tariffs, adjusting for tariffs, reacting to tariffs. I think it's an ongoing starts and stops, false starts, real starts. So we're going to talk a little bit about tariffs and what does that do to the market and to real estate and to investment in general. And then what are emerging markets? What are emerging trends? Is there any global risk that will impact our decisions here in the US? And ultimately, how do I translate it into my own company, into the decisions we make on a day-to-day basis? So hopefully we'll make it real for you. If I confuse you more than I help you, let me know, but I'll take a stab at it. One of the ones that I really love and I watch thoroughly every year is the one that Marcus and Millie Chap does. And they invite different guests. And one of them was Mark Zandi last year in 2024. And the predictions 2024 was that the economy is recovering and we were gonna have job growth, but it's gonna slow down over time. We're gonna see interest rate cuts throughout the year, but towards the end of the year. And things look that it was gonna be stable again, and interest drop is gonna continue to promote more economy growth, job growth, and real estate activity, which was kind of like on hold for a while, given the dynamics of real estate. And I think most of what we saw in 2024 was to point of what Mark has predicted. And Mark is a renowned economist here in the US. So up to like election time, it felt like everything is according to plan. Slow and steady recovery. Real estate is coming back more and more. Sentiment is building up, and we're on a good trajectory. And people were even more hopeful that's going to be further economic growth and further stability with the new administration and after the election. Normally, people in the election year are also extra cautious because they think everything is on hold until we see what happens. And that was the case. But we started to see some good movement in November, December, January timeframe. In 2025, there's going to be navigating few risks. This nothing new. We shared that last year. I'll show a chart here in a moment, kind of looking on what disruptors can impact the economy, what decisions, policies that can impact the economy, and the overall fundamentals. But in general, I would say it's uncertain where we're going in 2025, and people are more and more anxious, but mainly not driven by fundamentals of the economy. It's more driven by policy, especially economic policy. So it's in a way artificial Yes, we were not in a very stable place, but it felt like everything is going to be weathered if these economic policy don't create a great of a disrupt. And that's what we see recently. But here, really quickly, the biggest indicator of where the economy is heading is consumer spending. And now consumer spending normally is adjusted for inflation, and we make sure that we don't take care of inflation. But in general, the trend of consumer spending has been solid since COVID recovery and following that 2.5% since 2022. So that looks good. So consumer spending is there. Yes, debt in general is rising. So that can be a risk factor that we look at from a personal debt point of view and from a general business debt. But consumer spending is stable. So that's one good sign of the economy. Now, some of this might be driven by also increased um, prices of housing. But in general, it's in the right trajectory. This is normally a chart that they show of showing like the likelihood of a risk that can happen versus what the severity would look like. And mostly economy or global related, but the ones that they highlighted this year is a potential disruption of supply chain, concern to the Panama Canal. That was a concern. It's less of a concern now, it looks like, with the BlackRock move on that, but that still is a concern if there's a major disruption that similar to what happened in COVID. Potential tension can create more cyber attacks, and so that is another one that they highlighted. But if you look at it, it's kind of like following what the most likely is. If the Federal Reserve moves faster or slower, that's normally a thing that they're looking at, especially now with the policy changes, if it's going to impact federal jobs and ultimately layoffs, and layoffs leading to less spending. So are they going to have to cut interest rates faster than they planned, for example? That's a question. Um, and supply chain, we already talked about cyber attacks. So in general, I think everything looks fine, except if crypto market crashes, stock market crashes as an overreaction to what's happening. So that's kind of where most of the economists are saying it might be an overreaction, and they're just that we're going to do tariffs, we're not going to do tariffs, we're going to pause tariffs, we're going to reinstate tariffs. People were not taking it seriously early on. They thought it was more of a leverage by the US government over trade partners. But now there's an element of what is transitory and it's going to like go away, and what will be permanent, and we'll have to live with it. And there's arguments on both sides of what tariffs can do. In my opinion, personally, I think long-term tariff policy is bad, but I can see why they're doing it to bring manufacturing jobs back home and make the US exports more competitive. Now, that ultimately leads to a devaluation of the US dollar. So you can consider that inflation, you can consider that devaluation. So now people are starting to think, okay, this might be overall good for the economy, but where do we invest going forward? The stock market is inflated. Do we go back to the good old gold as a safe haven, hard assets, real estate, other things like that, as opposed to things that are going to be more vulnerable to these decisions? What I like about everything that they've talked about so far, it doesn't really impact real estate significantly, and that's a good thing for real estate, but it definitely will make people worried about their crypto stocks and other investments. What they're predicting this year depends on what happens on the jobs losses side, on the federal job losses, that inflation potentially is going to be stickier than they thought, that they thought they had it under control. It may now increase again. And that will potentially have the Fed move faster on cutting the rate. So they were already talking about cutting the rate twice this year towards the summer, and maybe after the summer, September and Q4. But with the data that is not clear yet on employment, especially on the federal side, it may have them move a little faster. So that might be good news from an interest rate point of view, but overall economy may not be a good news. So that's what the fiscal policy adjustment that we're looking at is. They're going to try to see, are we going to react too fast to what's happening now? Or should we wait another quarter before they kind of settle down on what they're going to do on interest rate? Overall, the interest rate that they had planned and we anticipate is highly likely is another half a point throughout the year. Again, can be accelerated. Job growth following trend, although revised data that they normally do after a year showed a little lower job growth than what they anticipated. But that also is a sign that economy is growing, but it's slowing down. And this is before the federal job losses. Um, Again, permanent or not, this is something to look for. But in general, the economy is growing, the jobs are growing, but a much lower pace than obviously the recovery from COVID and what happened towards it. So if that trend continues, then you can see that the economy is slowing down anyway. And that's what normally the Fed look at two things. They look at jobs and they look at inflation. If they manage inflation well and they start to see that we're slowing down on jobs, they're going to lower the interest to stimulate investment, job growth, economy. But if the inflation is high and the jobs are continue to drop, that's not a good combination because if they raise the interest to control inflation, we're going to lose more jobs. And that's what they're monitoring right now. So if inflation is a major indicator for me more than jobs now, because jobs, we know we're losing jobs. We're losing job growth, meaning we're producing less and less jobs than we used to. Um, so I'd say we're monitoring both inflation and jobs, but inflation is going to be a much faster data to look at. I think from a reaction from what happened last time. Last time, I think they waited too long on inflation before they acted. I think this time, at least indications from the economists, that the Fed will probably be forced to move faster this time. Another good thing for real estate and for generally the how we look at the tax cuts for corporates and the job tax cut and job act that was um, put into law in 2017. That created a lot of stimulated a lot of growth in the stock market, stimulated a lot of growth in real estate as well. Now, there's a big argument about this increases the deficit for the government, but it definitely is a short-term stimulant to the economy, both on the job side, on the real estate side, and on the stock side. Um, I think that everybody wants to extend it. The Republicans are introducing that funding bill. I think they just passed it a couple of days ago that will extend this 6 months, but they're trying to make it permanent. So that's what the negotiation are. What this does is going to continue to all the things that we enjoyed in real estate, the accelerated depreciation, the bonus depreciation, opportunity zones, and generally lower personal tax rates and keeping that pass-through entity deduction in place. So for real estate, this is great. For companies and corporates, this is great. Stimulate the economy in general, but the thing that is negative about these things is continues to increase the deficits for the US government. How does that translate into multifamily apartment investments? We're seeing renters are staying in apartments longer. So the gap between owning a house and renting a house is still there. Even though the interest rate dropped a little, it didn't create a huge wave of home ownership spike, I would say. If you can afford to buy a house in a good area, you're doing it anyway, and you can afford to wait to refinance later to a lower rate. But more and more, especially in major cities, we're becoming more and more of a renter's nation. We talked about this in multiple webinars before. that pushes us to focus more and more of, okay, how can we improve lifestyle for our tenants? And so it's not only apartments. We like the built to rent communities where it's a nice lifestyle. You can rent the place and potentially buy it later. But you still live in a good school zone. You still live good area, and there's nothing you can do as maybe a new family to buy a house in major cities. Um, it's cost, but mainly it's interest. Construction cost has risen as well. For you see the builders are building less homes than they used to. But in general, demand for multifamily is strong. Rent is flattening in multifamily apartments. Rent is flattening. It kind of in the inflation period, it used to spike really high, and we had huge increase in rent, and then kind of stabilized and went negative a little bit. Now we're starting to see it to stabilize again and increase. So the rent is relatively stable, but the operating expenses are increasing, whether it's utilities, tax, insurance, labor in general. So when we look at multifamily, we like the multifamily industry in general, but we're not doing more and more apartments in 2025. We're focused on build to rent community, low density, nicer lifestyle type of products. But again, this is not affordable and it's not for everyone. So it's kind of like multifamily is kind of like in a place where if you own a multifamily property, you stay there, but maybe you shouldn't start a new building. And that's what most of the real estate developers are doing. They're not developing new apartment complexes. We already have oversupply, and they're kind of waiting for that demand to catch up on the supply. But great news for BTR and great news for senior housing. And that's what we focus on. When it comes to office, I mean, office sucks. I mean, everybody knows that. I'll show you some data around working from home. A lot of people are going back to work, but in general, office is in a very bad place. In Houston, for example, we anticipate a whole decade for the demand to catch up with supply. And so an average 26% for older towers that are closer to downtown. And it's a much better story when it comes to suburbs. There's a lot of development happening on suburban offices. Normally, they're much smaller footprint in the neighborhoods where there's more housing happening. But in general, offices is not good. There's exception to that when it comes to medical offices and suburban offices. We normally focus on those two, but anything towers, downtown, midtown, very vacant, and some lenders are not even lending on those buildings. So the only things that are happening there is lenders are refinancing or remodifying the loans with the current owners because everybody's going to lose. And for us, we're not really focused on offices. We're focused on medical offices and suburban, sort of smaller footprint type of office retail. We talked about tariffs, and it's a great uncertainty. Most of the economists I watched over Tuesday and Monday night and Tuesday night, um, they still think there's two types of tariffs. There's like I said, the leverage negotiation type of tariffs, and there's a permanent, we want to move manufacturing closer home type of tariffs. And they have everybody's uncertain about what those will do, and everybody is anticipating, but it's not clear if this is going to continue to be the case or things are going to stabilize. And what happened on Tuesday with the stock valuation going down significantly. I think it's the seventh biggest drop ever, and it's probably going to drive some stability too. Like, it's almost like the policy is moving the market, and the market is like ignoring it, and now they reacted to it. And so hopefully that slows down the policy. So it's almost like a feedback loop of like, hey, you're overdoing it. This is too wild. Let's stabilize a little bit. So that I'm hopeful about, but can't be certain that, craziness is going to continue. Um, Retail is the new apartments and office is the new retail. So like this is just kind of sharing that retail also is slowing down. There's a lot of movement into online buying and not having to go to a retail shop to for shopping. And so retail has been always great and the darling of real estate, commercial real estate specifically. And we started to see signs of slowing down on retail. Now, for every rule, there's an exception. In general, retail is slowing down, still a great asset to own, but it has to be in the right location. So not all retail are created equal. Retail does really well when it comes to suburban areas and new development areas, but older retail shops are not as occupied as it used to be, and the demand is slowing down a little. Obviously, big retail is bad or worse, I would say. Smaller retail is better. All right, so we looked at another couple of data points from these reports on, okay, I've talked about a little bit of real estate based on what Marcus and Millichap is looking at and how we interpret it, but there's also more data points that we looked at. Normally, in any market cycle, we always like to refer to these. We shared these last year as well. It's kind of like the cycle of emotions in any investment when the market is growing and how people react to things. If you pay attention to anything today, look at this chart on the top right corner. This is how people screw up their investment decisions. They are either too excited, they're always too excited, but either on the positive or on the negative side. So when the market is growing, everybody is excited. You get to the maximum point of financial risk, you're taking crazy decisions, and this is the euphoria of the market. And then you start seeing the market go down, and that's a cycle that happens all the time. People first deny it and fear it and panic. They make a bad decision. Then it gets to the base and the bottom, and then they start going from there and building some hope. I'm hopeful. I feel like we're in a hopeful market, even though people might be in a panic mode right now. Um, but again, governed by if there's any no more disruptions in the economy. When it comes to real estate is on the path of recovery, and the huge bubble that was created post-COVID, for the most part, is gone. I believe we've already reached the base and the bottom, and we already are going on a positive side. And personally, in InvestStream, we're doing more projects than we've done in the tail end of 23 and all of 2024. When it comes to stock markets, a different equation. I think the stock market is here, denial, fear, place. Now, it doesn't mean that it's gonna like collapse from there, but people needs to be aware of that. Now, when it comes to wise decisions, real estate in general, you're kind of stuck with your decision. So sometimes that offers some protection from from making emotional decisions. Because like we normally do projects for 5 years. So whatever cycle happens, we'll see the other end of it. But when it comes to stocks and crypto, you're one click away. So if you're anxious, if you start to get some fear, generally we say you're a long-term investor. Don't make rushed decisions now. It may get worse from here. You may buy more stocks if it gets worse from here. But always think like a long-term investor and don't try to trade your portfolio in the middle of a panic. A lot of people, what they do is they're going to sell their stocks and buy expensive stuff, real estate and gold, or try to keep cash. Well, with cash, you have inflation going as well, so may not be the wisest things to do. But if you make any decisions, make sure you're thinking long term and you're not panicking, and you're kind of following the panic wave. But hopefully, we don't see another panic wave. Hopefully, that was just a warning sign that will make things more wise and more stable on the stock market. But in general, whether it's even if we see like a more disruption in stocks, if people already exited stocks earlier, it's good to either buy more if it drops more or switch your portfolio. So anyone who asked me for quote unquote advice, I told them, don't sell now. If you already sold, invest it somewhere else. If it drops further, invest more. So that's kind of how how I'm looking at stocks versus gold versus real estate. But overall, I think economy-wise, we're getting out of the winter in general. Again, provided that we don't have more disruptions. So enough of that. I think everybody is still excited about real estate. 65% of respondents to PwC survey that they anticipate more profitability in real estate, um, from good to excellent, basically, for real estate, and that's kind of the sentiment in general. Um, so why does this matter? Because not all markets are created equal. We have Dallas and Houston growing like crazy. We are invested in both markets. In the last 3 years or so, Dallas and Houston has exchanged number one and two, um, nationwide. And the 2025 projection continues to show Dallas as number one nationwide and Houston number three right now. For good reasons, you have real economy in Dallas, total employment growth throughout the roof. The growth in Dallas is phenomenal. We just had a project in Dallas, a construction of a built-to-rent community in North Dallas, and demand. And like we continue to update the pro forma because it's just improving over time. So we made conservative assumptions on rent. Well, rent is improving. We're making conservative assumptions on occupancy. Well, occupancy is improving. So Dallas is a magnet to the nation, and it's doing real economy, um, driven by real jobs and high wages jobs for the most part. Houston continues to be a center of oil and gas. Oil and gas is getting a lot of boost with the new administration policy, so that's great news for Houston. But Houston has diversified over the years, and we have huge bioscience and medical, the biggest medical complex in the world, huge into bioscience now. A lot of headquarters are moving here, and the port continue to be solid, about 20% of Texas GDP. So huge economic driver. And it is the fifth largest MSA in the nation, although they argue now it's so widespread. If you include all the metro area and the surrounding suburbs, we're number three, but officially we're number five. So Dallas and Houston will continue to work on that. And we are expanding into Oklahoma City. There's a little bit of a spillover of what's happening in Dallas and Oklahoma City and makes it a wonderful place. In general, I love the South Midwest region. Um, and it's where migration is happening, where companies are moving, where people are moving, and those are good signs for the investment in real estate in general. Okay, I think I covered some of what happens on interest rate, but let's talk about a little bit on the hybrid work, or working from home. A lot of people said that it was a disruption and everybody's going to work from home early on. And then we have the mandates to go back and work from the offices. I personally enjoyed it because Houston became less trafficy. You can drive on the roads in Houston, but we started to see that mandates coming in late 23 and early 24. And people thought, okay, this remote work was a myth. Everybody's going back to the office, and it's not. So it's more hybrid. And hybrid means different ways for real estate. We're going to look at having a permanent office in our design of our housing units and making sure that we have a couple of office spaces at the house for the couple to work. It means that office is going to continue to struggle. Although demand is picking up and people are going back to work, it's not going to be what it used to be. So it's somewhere in the middle, is what I'm trying to say. It's not everybody's going back home, and it's not going back to the office or staying at home. Now, there are different industries that spun off after COVID that drove more office warehouse needs, maybe Amazon related type of warehousing, people working from a smaller office footprint that has a warehouse extension to it, as opposed to the traditional office buildings. But overall, we're going to be in this kind of steady state of hybrid working environment, and we're adjusting our investment strategies accordingly. Normally, I like to see this once a year. Or what are the things that normally disrupt real estate or potentially disrupt real estate? Number one, always construction cost. If it's more expensive to build, it's going to impact the price, and it's going to impact affordability, and it's going to impact rent, and it's going to impact home prices. So that's a major thing for us, and it continues to be. The Canadian tariffs are going to be the number one thing we're looking at, when it comes to lumber and steel. That's the number one, and that's the one that we're more hopeful about. That it's like more leverage and bluff than permanent, as opposed, for example, to the China tariff. Now, the China tariff impacts us on fixtures when it comes to plumbing, electrical, things like that. So there's a Canada problem and there's a China problem, and we always try to see how we can do that. Labor has increased and continues to be a major factor. Obviously, we talked extensively about interest rate, remote work, and what's the impact of the footprint and the plans. But the ones that we really, really like is the baby boomer phenomena. 10,000 baby boomers are retiring every day, and it's increasing. I think it's closer to 11,000 every day. And that means that we need more senior housing, we need more senior care, and we translate that into senior housing projects. We translate that into medical office buildings, whether it's acquisition or development. And the normal thing that normally happens when housing becomes more expensive is everything shrinks. That's the other trend. So we're trying to balance between how can we make a project work without offering a very, bad plan in terms of like size and lifestyle. So how can we balance lifestyle with the increased construction cost without sacrificing quality? And then how can we offer more and more tailored housing solutions and care solutions for the aging baby boomer? And that's actually one thing that drove us to doing BTR, like I mentioned earlier, but actually doing senior housing as well. And we're working on a project in Oklahoma City for senior housing. So you can see these trends are adjusting our strategy. We're not completely shifting from multifamily. We're doing a more tailored solution in multifamily. We're avoiding office. We're doing medical office. We're not doing traditional office buildings. We're doing office warehouses because there's more and more trends for service companies to be in the neighborhoods as opposed to on the highway. Um, and then the last mile delivery when it comes to like online shopping and being close and having that beautiful one-day delivery phenomena. There's more demand for local small footprint for warehouses for those Amazon sellers. I think I covered most of this. I mean, the top 3 or 4 hottest things, and I feel like good about how we think about it and the actual prospects for asset classes, basically. Data centers. Data centers, number one right now. Everybody is investing in data centers. AI is driving that, and nationalization is driving that. So both of them, we need more data centers here, and we need more horsepower when it comes to computing. But that's a game for big money that we don't participate in, but it's a cool thing. We see big investments announced on data center in the last couple of months, and that continues to be a trend. The ones that we play in are more senior housing, which shows these are number two, and we do flex warehouses. It's on the high side of things. We don't do a lot of things on student housing, but that's a good thing. Um, Multifamily stays to be strong. We're just very selective of what we can buy and where. And the ones that we also like is medical office and the single family rental. So if you think like about our strategy movement between 2023 and 2025, we kind of shifted away from the traditional retail. We've never done hotels per se. Well, we didn't do a lot of high income apartments. We did more and more apartment for workforce, but now we're opening up for flex spaces, warehouses, BTR, and medical offices. All right, finally, globally, how does the world look at what's happening in the US and how it's going to impact them and how they're going to impact us? Again, it comes back to policy and wars. Right now, there's continues to be risk from weather, and that maybe is doing more global migration, not necessarily impacting the US. It was impacting the US in the Caribbean area, and that continues to be a risk. But the biggest risk is just armed conflict around the globe. Again, disruption of supply chain, and that will cause inflation. So we'll wrap it up. I shared, what's happening globally can impact us, what's happening on the economy, what's the impact on real estate, and what to keep in mind. So as a summary, I would say, again, the fundamentals of the economy are sound. We're not in a desperate situation, and the economy continues to grow. The tariff policy is causing disruption, and that can be transient or permanent. We continue to watch what's happening with Canada specifically and Mexico as opposed to what's happening with China. And as the economy continues to grow, we see that it's going to slow down and it needs a stimulant from the Fed, meaning a lower interest rate to grow it again. And that's, like I said, indicated in the job growth. So nothing to worry about other than the tariff policy and whether or not what's going to be permanent or not. And a lot of the economists say, even if the most of these tariffs are permanent, it's going to allow companies to make decisions. Right now, uncertainties, just people are not making decisions, meaning are they moving manufacturing in-house to back to the US? Are they doubling down on Vietnam as opposed to China? Are they doubling down on that Canadian imports or slowing down Canadian imports? So people just want more certainty. Once that's achieved, companies and CEOs and CFOs will make decisions and will adjust accordingly. To us, the sentiment has improved and continued to improve in real estate. We see that with our investors as well. More investors are coming back to real estate. But any recent disruption in the economy, people get worried again and be like, is this the right time to invest? Should I wait? And most people wait. As long as you have your money in a place that it doesn't depreciate, that's not a bad idea. But if you have it in places where it's potentially can decrease more, then I would be more worried. There are some early signs of people flocking to hard assets. We see it in real estate. Gold price, go check gold price. I think it's 3,500 already or almost. Um, yeah, but I would say it's early signs. I wouldn't say like people are just going to panic and the economy will crash. Again, that's crystal ball talk, but again, we're sharing what we see. My worry that inflation is going to continue to be stickier, meaning they're not going to hit their 2.5% target. We're probably going to float between 3 to 4%, and they're not going to be able to control it because it's going to be more important for them to maintain jobs and keep the economy going than trying to tackle inflation. So it's good news for real estate because interest rate potentially would drop faster, and that will create a movement into buying homes or renting more affordable units from a rental market point of view. So with that, we saw, some confirmations on we've, more interest rate cuts than anticipated. Crow Holdings is another report we looked at it. So that was something that it was kind of nice to confirm our assumptions when we saw that. And for InvestStream, in a summary, um, uncertainty is here to stay. Stability is there. We're making long-term investment decisions. So if you look at the sectors of like what asset classes we're in, we feel great about them, whether it's medical office, built to rent communities, office warehouses and very selective approach to apartments. And we love that we're aligning with where the market is going, but it has to be location aligned as well. Not all real estate is created equal. Houston, Dallas, Oklahoma City markets are great. We have boots on the ground. We're lucky to be in that region, in this area. We can see that continuing in the next decade plus, and we're just going to double down on what we do in real estate. Um, yes, I'll wake up and watch The Economist and kind of feel the people and understand the pains of stocks. But I vested a lot of my stocks earlier, at least for me, and moved the money somewhere else. And I hope many have done that as well. If you haven't, don't do any crazy moves. And that's my advice. With that, we'll open it up to Q&A. And see if you have anything in the chat, Sammy, already. And then if anyone wants to share more, please go ahead.
Yeah, nothing in the chat yet, but yeah, feel free to add a question to the chat or you can unmute and ask a question. And if there's
Good,
any links you want, just let me know and I can share those in the chat as well.
good morning. Can you hear me?
Yes. Hey, Naveed, how are you?
Hi, good. I have to say this is one of the best, robust, and complete presentation I have ever heard from you. This is amazing.
Uh,
Good job. And a lot of those,
that's an amazing compliment. I'll take it. Thank
yes, a
you.
lot of them I can relate because I was working from home for many years now. I've been asked to go and so I can relate a many data points what you just said. Amazing research. Thank you. I
Great.
have
Thanks.
one question. You touched upon a lot of industry aspects and lumber and all that. With the NATO, with the new president we have, and the way the president thinks about the NATO and all that, our European partners are very scared and they realize that they have to build up their own defense industry. They cannot rely upon the big brother, and they have pledged to spend or yeah spend about $850 billion in 5 years to rapidly grow their defense industry. Do you have any thoughts uh, about that? And again, our little brother up north, Canada, is also scared. They might want to do their own thing. So anything that you can project an
Yeah.
opportunity for investors to do anything?
Yeah. Um, Canada is easier. I think Canada is gonna be more of a negotiation on some trade parameters and we'll be fine. I don't think Canadians will like change their fiscal policy. I think they're just trying to push back right now, is what I'm seeing. So I think they're going to have an agreement, and I'm not seeing a huge thing. I do know a lot of Canadians are investing in the US, real estate and other investments. They may, politically slow down, but that's on the Canadian side. On Europe, I think it's a more chronic issue that they're going to have to invest on their military, increase the budget on the military side, and I think they're in trouble because their market has been open to China more than the U.S., and they're going to go nationalism all the way, I think, in Europe over the next few election cycles. So what that will do is it will disconnect us more and more from Europe. I think it's bad news for Europe. I'm not sure if it's going to impact US investors and or economy. I think it's more impacting Europe itself.
Thank you.
As usual, we are recording this and we'll be posting it on our YouTube channel. And we'll meet again on the second Tuesday next month. Um, do we have something prepared already, Sammy?
We do. We've got to decide. We've got a couple topics that we're deciding between, so I'll share that soon.
Very good. Stay tuned.
All right. Thanks, everybody.
Thanks, everyone. Have a great rest of your weekend, and we'll see you soon.